We're going to talk about the market. We'll do a quick recap. We've already gotten some requests. We'll just do a little market recap on the equities, gold, silver. We're going to talk about expectancy. We're going to talk about probability. And we're also going to talk about seasonality. So tonight's session is going to last about 40 to 45 minutes. It's not going to be real long. We want to respect your time. And if you guys have questions, please feel free to type it in. And with so many of you folks here tonight, because Steve has an incredible loyal following, if we miss your question, just type it in again. Give us an opportunity to answer. But just type it in, and we'll go back and we'll try to answer every single question you folks have. So, without further ado, let me get Spy up here. I'd like to bring Gareth in. By the way, I told you my name is Ron Haight. I'm the VP of Market Tamer. I'm on the customer service side, operations side. I'm a trader. Some of you guys have heard me before, and you've heard Gareth. But real quick, my background, trading for about 10, 12 years. When I first started trading, I didn't even know what an option was. I was probably as far away as you could possibly come from a country farmer, whether it be potatoes or pigs, and then work your way into the stock market. It's a long story how I got involved. I don't want to share that with you tonight because you probably don't care. But it was interesting how I actually got into the stock market. Gareth is the founder and president of Market Tamer. He has created the algorithm that you guys have heard about. He has created the major market trend indicator. There's basically only 3 people that know what goes into it, and we can't tell you. That's the one question we can't answer. I'm sure that's going to come up, but I'm going to have Gareth come on in. He'll do a mic check, and while he's performing the mic check, he can give you just a 30-second bio on himself, and I'm going to activate the picture. Okay? So Gareth, do you want to come on in? I'll quickly go on mute, and I'll get the screen share ready.
Thanks so much, Ron. Welcome, folks. It's a pleasure to be here. Thanks so much again, as Ron mentioned, to Steve for having us. During this session, we're actually going to mostly have a conversation. We hope that it's going to be an interactive one with you also, and would really love your feedback and questions, comments throughout the session. So usually when we're on here, it's maybe sometimes a more formal presentation. This time we decided we'd mix it up, keep it lighthearted, and so I see people are just saying no picture. If you guys, hopefully you can hear me. The picture's about to come in. Ron's just doing a screen projection right now. And we're going to start out by discussing the market. We're going to talk about 3 signals, 3 indicators, and highlight a little bit of why one might be more important than another, and talk about 2 that are conventional but may not necessarily be as accurate. So let me confirm that you guys are hearing me. I know that most of you, it seems, are not seeing a picture. That's fine. But if you are hearing me, just go ahead and type in yes. All right. Are you guys hearing an echo? One person said echo. Everybody else, I think, is loud and clear. No echo. Right. Wow, you guys really are fast off the mark there. All right. So Ron should just about have a chart up and running here. And we'll just talk for a couple of moments about this chart. We won't get into candlesticks or technicals necessarily. We'll leave that to Steve. He's the expert on that. But what we will talk about is direction first off. And so let's move all the way back, beginning here, right around the June period. And what I'm going to do is ask you some questions throughout this session, and then I'm going to hopefully lead you to a place where when you start thinking about charts, you can think about them not just from a technical analysis perspective, but also from another viewpoint, and we'll work our way towards that. So first thing is, if I were to ask you, based on the current trend over the intermediate period, maybe 2 to 3 months, maybe in 4 months, what is the direction of the market? So we'll start out with an easy one. What is the direction of the markets? So go ahead, type in your answers there, and Let's see, we've got about 300 people here, so don't be shy. Go ahead and type in your answers, and I think it's pretty uniform right now. Clearly, we're looking at an uptrend, right? John G., I love your answer. 45 degree. That's great. That's great. You've got the measurement already calculated. All right, so we're moving up. Now, what does that tell us? Well, we know a few things at this point in time. One of them is that we've got positive momentum. And when traders begin trading, they often look to momentum and think, gosh, that's a really important indicator because now momentum is likely to be a catalyst for more momentum. That is, as stocks keep rising, they continue to keep rising. Rising stocks beget rising stocks. So that's typically an intermediate way of looking at the market, saying, you know what, everything's going up, things are going to keep going higher. Let's move on, though, from there. Now let's look to something else, which is the probability. So right now, if you were to look at the direction of the market, we could say the direction is up, the momentum is higher. What is the probability of the market moving up over the next, let's just call it, few weeks? So we know that we're in an intermediate uptrend here. We've got a positive trend all the way since the beginning of June. What is the probability of the market moving higher? So go ahead and answer that question. If you were to have that question posed to you and you had to answer it, what would your answer be? What is the probability of the market moving higher? All right. So we've got, this is good. This is really good. We've got answers all over the place, and that's part of why I'm asking this question. So I'll take a few comments that come in here. Just mentioned it depends on what the election brings. One of the things to pay attention to is that there's always an externality. There's always something in the markets that is not quite normal or not quite, can't be. If you were back in the 70s or the 80s, you might have seen and lived through some really high inflation periods, very high interest rates. If you're looking at the 90s, obviously you've got this massive move up in the markets. Then you've got this big, long move in bonds and the decline in yields. And everybody was thinking, gosh, it's 7%. It's got to bounce at 6, at 5, at 4, at 3. And yet we get all the way down to where we're at right now. So looking to the market direction and momentum, we can see that it's moving positive. Looking to probability, now we've got a much more challenging thing to figure out, because if we're looking at some answers here, we're seeing the probability of moving up is very low. We're looking at some other answers, we're seeing it's very, very high. So why is there such disparity? Well, probably there's disparity because each of you is looking at the market through the lens of your own viewpoint, which is maybe you're looking at it from the perspective of it's already come up quite substantially, and as a result, maybe there's not much to go on the upside, so maybe the probability is low. Some of you are looking and saying, actually, what I think is going to happen here is it's going to continue because the past direction has been positive, and typically if there's historical movement in one direction, it's best not to fight that until it reverses direction, and then the probability will change. If we're looking right now at probability, usually the rule of thumb is that as the market continues in a certain direction, the probability tends to favor that direction. Now, on any given day, you could equally argue that there's a 50-50 chance of it going up or down. The problem with that is it's not necessarily true, and you can see that over time, that over the last, let's say, 4 months or so, June, July, August, September, the market's actually moved higher overall. So while maybe on any given day the market may move up or down, the general trend has continued to play out to the upside. And you can see that every time we've come down towards the lower end of the channel or a 20-day moving average, we've tended to bounce. So there's something deeper than just the conventional wisdom of 50-50 chance of up or down. So that brings us to maybe the next point, which is that one of the ways to really think about the market is not just to limit ourselves to a probability, but also to incorporate something else, and that's magnitude. And the way I think about this, to provide an analogy, is to think about Google. The reason I mention it is before Google, there were a lot of search engines. You could go to Yahoo. There was Ask.com. There was Ask Jeeves. Oh gosh, what else was there? There were tons of them out there. And basically, Lycos, yeah, that was the one I was trying to remember. Thanks, Dal. There were lots of them out there, and they were all doing something pretty similar, which is they were grabbing information you type in. For example, you're looking for Japanese candlesticks, and you may end up finding that there are people selling Japanese candlesticks in Japan. That's not really what you wanted. What you wanted was a technical charting program from Steve Bigelow called Japanese Candlesticks. But you couldn't find it. Then Google came along and suddenly you could find that. And you could find it because it was at the top of the search results. So what had they done? Well, they'd effectively realized that Japanese candlesticks sold by Steve Bigelow is in fact very, very popular. And it turns out that a lot of people like the page, a lot of people visit his site, a lot of people buy the books, and so forth. And so they realized, wait, there's something in this. There's a rank, there's a priority, there's a quality. And ultimately what they did was they multiplied two things, or they ANDed them in computer terms. They ANDed search and quality. And suddenly you got high quality results. And so that would pop up to the top. Now, why am I going down this path? Well, it all relates back to the market as well. If you're looking to a chart here, what you have to do is ask yourself, what is the additional term beyond probability? What is beyond momentum or direction? And that term is labeled expectancy. And what it does is it combines or multiplies two terms. It multiplies probability and indeed magnitude. And so when we look at those two terms combined, we see a very different picture. Now, let me describe it to you maybe with an example. Let's, for argument's sake, define a probability today. And it doesn't really matter what it is, but it's important in understanding expectancy. Let's just say the market is generally moving higher and has done so over the past 4 months. We all agree on that. Now, the next thing is to say, let's define the probability of it moving higher from this point as 60%. Now, we'll come back to probabilities later on and understand how to maybe calculate them. But for right now, let's say it's about 60%. Okay. Now, we also need to know how far is the market going to move, if it moves. At this point in time, we've gone past the previous high of the year, around 1420 or so, set in April. We're up around 1440 and change. So the question now is, how high can the market go? Now, some of you will probably answer, if the Fed keeps printing money, we can go to infinity and beyond. Technically, theoretically, that's probably true. Practically, it's probably not going to happen. But we are in a situation where we've gone into that, quote, blue sky territory, where maybe there's no clear resistance right around where we're at. If we were to scan out over a multi-year period, in fact, why don't you try and do that, Ron? I'm not sure if you can do that, but see if you can get to, see if you can get to a 12-year period. If you can, let me know. If you can't, great, you can. 20 years, perfect. Let's just go back in time. So maybe you can try and draw a resistance line right up to where the market was back around 2000, and see if we can actually pick the high there. What was the S&P level? Somewhere around 1550, somewhere around there. Let's see. Go ahead and let me know, Ron, if you want to type it in. I'll let you figure out exactly where the peak was, and then we'll talk about it. 1552? Great. All right. So we know that the high during the bubble of the tech period was around 1550. We're what, 108 points away from that, somewhere around that level, about 100 points away. All right, so now we've got a magnitude, which is the high over the past decade or more has been about 100 points up from here. Where's the low been? Well, the low's been considerably lower. We know we were down at 666 down in '09. We know that, 03, late October '02, early '03. We were also down, I think, somewhere just below 800 or so. So know that there's quite a long way the market can drop, all the way down about 600 points if things go really, really badly in the short term. They could certainly get down a couple of hundred points, 300 or 400. That wouldn't be unusual. We've seen that over the past couple of years. It's been down there. All right. So then we can say, okay, maybe there's a 60% chance that it could go up 100 points, but there's a 40% chance it could go down 300 or 400 or 500 points. And suddenly when you start doing that calculation, you come up with wildly different figures. Let's just say the market could go down 300 but up 100. Then you can say there's a 60% chance it goes up 100, and there's a 40% chance it goes down 300. Ultimately, what you end up with is lower reward to the upside than risk to the downside. Now, what happens when you have greater risk than reward? You end up ultimately with negative expectancy. And so this is why when we're looking at the chart as it stands right now, and people can get very bullish on charts when they've been in uptrends, there's also another calculation to pay attention to, and that calculation is effectively expectancy. So when you're looking at fundamental analysis or technical analysis or sentiment analysis, they're all very valuable. Each will provide valuable information independently, depending on the time frame of investor you are. But independent of all of it, there should also be a calculation of risk and reward, and that's really the point of this early segment that we wanted to talk about today, that it's not sufficient to just look at the market as one in terms of direction, momentum, probability, trend. It's also very important to look at it in terms of expectancy. And a way of thinking about this, if you're thinking of an analogy, is imagine I came to you and I said, look, I'm going to give you $1,000, and for that $1,000, what you have to do is jump off a bridge that's 30 feet above the water, and there's going to be a 95% chance that you're going to survive. And you say, well, that's pretty good. I can jump off, maybe I can jump off 9 times, maybe 95 times out of 100, and I'll be fine. So you keep jumping. Maybe you jump 1, 2, 3, 4, 5, 6, 7, 8, 9, and you get $9,000, and you're thinking this is great. So you jump off the 10th time, but it turns out the 10th time is actually the time it doesn't go well, and you end up getting wiped out. Well, now it doesn't matter that you had $9,000 in your pocket because you just lost it all because there's no more you. Now this is, it's an extreme example, but it's a visual one to explain why when you're trading the markets, it's not sufficient just to look at trend and fundamental analysis or sentiment analysis or momentum or probability or direction, because there's another component, which is if things don't go well, you also need to understand how badly things can go. And that measure is it's hidden within expectancy, and it ultimately pertains to risk. And if you've ever had big drawdowns in your account, which if you're a trader, you probably have, and I certainly know I have, Ron will say he has as well. I think we all have to put up our hands and say we've all had that. But if you've ever had big drawdowns, it's most likely because there's been something you've been not factoring in, and that something is expectancy. So it's something that we pay very close attention to at Market Tamer. It's one of the reasons why we have some short-term indicators and some long-term indicators which both pay attention to that concept of the direction, momentum, and expectancy. Because what happens is a lot of traders will look at the market right now, and I know certainly those of you who are looking and saying probability is high that the market will continue to the upside. You may well be right. And you may even, some of you may even come along and say there's a 90% chance it's going higher. I think I saw it as at least as high as 75%. But the danger of doing that is that if it goes wrong, it can go wrong big time. And even if you're looking at a 20% chance of being wrong, it's okay to have that factored in as long as your portfolio too is protected in the event that that happens. There are ways to dampen the volatility, the risk of a portfolio. Obviously, if there is a correction through all sorts of instruments, our favorite, a market tamer, are put options, and we tend to implement a lot of actually pretty creative spreads, which are not typically applied by most people, but there are ways to effectively limit risk to certain price points, down to certain levels below which you know there's not going to be a whole lot of movement below that level. So one approach to that is if you already have a stock, you think, you know, and I think the market's going higher, you can place a put option against that stock. That's pretty standard as a protective measure, but you can also go down to a level where you think the stock market is not going to fall below a certain timeline. You can place a short put down there too. You can combine the contract numbers too, depending on your outlook. And effectively what that does is it limits your risk to a certain level, but not below that level. And the proviso is that the market isn't going to drop below that point. So this was just an introduction to the first part of our conversation today. And what I'd like to do right now is just transition to the seasonality component that Ron introduced at the beginning. Ron, maybe what you could do is bring up, if you wouldn't mind, bring up a newsletter. In fact, if you bring up today's newsletter, that would be great. We're seeing, let's see, what are we seeing? We're seeing Market Tamer come up now, and Ron is logging in Market Tamer. And so what he's going to bring up is the newsletter that we publish 3 times a week. It basically comprises some seasonality information, and I don't think it's probably going to be a good use of your time for me to just jump into it. So I'll introduce it with a little bit of background, which is that if you were to look at some old adages in the market, for example, you might look at sell in May and stay away. If you look at, let's see, performance indicators such as from May to November, typically the market doesn't do as well as from November to May. Or indeed, if you're looking at effects like the Halloween effect, where maybe it's good to buy candies and Hershey's right before Halloween. These are true effects that happen time and again, the Santa Valley and so forth. In fact, it doesn't just carry to the markets, it carries over to other disciplines, such as in the medical area, there's the July effect, where it turns out there's a spike in inaccuracies in hospitals and operations, surgeries that don't go as well. So if you're ever considering a surgery, don't think about doing it in July. Think about some other month. Why? Because that's often when residencies begin, new college graduates come out, the new medics are beginning, they're training, they're learning, they're making mistakes, and inaccuracies take place. And it just happens that year in, year out, you get to see this July effect. Similarly in the market, we have all these old adages. And that's great if you want to stick a Post-it note up on your computer and you say, okay, it's May 1st, maybe I should sell the market and stay away for the summer. The problem is that some years we actually get pretty good summers. From June to September, and indeed October now, we've seen a pretty decent market. So there are rules of thumb, but they're not necessarily guaranteed. And one of the things that is nice is to be able to actually see what happens to an individual stock. What would it mean if you knew how Apple performed every single May or every single June or July or October? Well, right now we're in October. So how does Apple usually perform in October? How does a stock that you're interested in? Are there stocks that typically perform really well or indeed really poorly? And so we actually publish that information 3 times a week. And maybe, Ron, if you wouldn't mind scanning down, I just want to introduce there's a Cisco position. I'm not entirely sure where it is in the newsletter, but I think it's closer to the end of the newsletter. And the reason this is quite interesting is that back in September, we were actually very positive on the markets, yet at the time there was a lot of concern. In fact, I was reading a lot of newsletters that were saying, oh, the market, I think at the time the market had just breached one day, it breached below 1,400, and they were saying, this is the end, the market's crashing, it's going to collapse from here. And we were looking at all of the seasonal information and realizing, actually, seasonally, September tends to be a really good month. There's a lot of support. October, difficult or really bad reputation. And in some ways it's deserved because a lot of the crashes that have taken place in the markets have all taken place in October. Turns out that it's usually the last couple of weeks in October where October really earns its reputation. But for most of October, seasonally, and there's no guarantee, but seasonally, it actually usually performs. So thanks, Ron. You're coming down to Cisco. There's just one. Keep going. Might be just on the next page or so, but there's just a chart that I want to highlight. Not the chart of Cisco itself, but below that, just highlighting some of the seasonality factors that go into our analysis here of this stock. And you can keep going lower. Yep, that's the one. Yep. Just scan up slightly there. You might have done it already, Ron, and I'm about to see it. So I can see, yep, perfect, that yellow chart, Ron. There we go, just in frame. All right, so it should clear up on my end. All right, so what are we looking at here? Well, we're looking at the historical weekly average gain chart of Cisco for October the 1st, 2012. And what this is telling you is if you were to purchase Cisco and you were to stay in the trade for a number of weeks, how would Cisco have performed historically? And here you see that if you were to stay in the trade for 2 weeks, 3 weeks, 4 weeks, 5 weeks, let's go to 5 weeks because it's an easy one to see there. If you were to stay in Cisco for 5 weeks, the average gain there is about 7.6%. If you were to buy from this week, on average, that's how Cisco usually performs. Now, if you were to stay in on average 10 weeks, you go up all the way to 17%. If you stay in for, 19 weeks, you see a gain on average of about 28%. I mean, these are really valuable results to have on hand because what happens to most of us is we look at a recent chart. We look at the last 2 or 3 months. Then if we're getting interested in our due diligence on a company, we often expand it to 6 or 12. Maybe we even go to 24 or 36 months. Here we're looking back over many, many years. For example, in 2011, we can see that this was a stock up 24%, 2010 up 10%, 2009 up 2.3%. 2008 was the really bad year. 2007, really bad year. It's when the market was correcting, down 13%, down 24%. Before that, in 2006, it was up 16%. 05 it was down 2. 04 was up 9. 03 up 11. And then back over time, 01, 02, it also had really good years. So typically, when the market's not crashing, like in 2001, like in 2007, 2008, Cisco actually tends to do really well. It's had very good years. From 1990, as high as 50% gain to last year up 24%. And this is just seasonally, just looking over this period of time from October 1st. This is sort of cutting edge. It's like as of today, over the next 18 weeks. So this is something that you can track now. Try and pay attention to Cisco. Now, obviously, we've got a bunch of other stocks in here which our members get access to, and you might have glimpsed some of them as we were going through the list there. But essentially what this does is it gives us that win rate. It tells us not necessarily guaranteed, but it gives us a probability where we can say, okay, if we were to stay in this trade for about, let's just go with 14 weeks. Well, what do we typically see? Well, the win rate over a 14-week period is 82%. All right, so now we can interpret that or infer from that there's a high probability that this is a stock that's going to win over time. And from that probability, or from that win rate, we can infer a probability that is going to be equivalent. And say 8 times out of 10, 8 years out of 10, Cisco tends to outperform over the coming 14, 15, 16-week period. In fact, 82% of the time, that's what we see. Will it happen this year? Well, if the market starts to crash and we start to see big problems, then we'd say arguably it won't. Because why? Because we've got a correlation in 2001, in 2007, 2008 with the market. So we also know that it doesn't trade in an anti-correlated fashion with the market. If the market isn't crashing, we'd say there's a pretty good chance this stock is going to do well. Now we've got a probability. We can go take a look at a chart. And Ron, maybe you can bring up a chart of Cisco, and we'll take a look at both the magnitude here and come up with just a back of the envelope calculation for our expectancy. So yeah, we'll go to a shorter time period here. Take a look at Cisco. And Cisco doesn't tend to have huge price moves, but one of the things that happens when you're trading is you start looking at stocks that are at 19 and you think, gosh, if it gets to 20, that's not great. It's only up $1, but it turns out it's actually more than a 5% move. So it's often easier to think of, say, $2, $3, $4, $500 stock moving up by $25, say a $500 stock going up to $525, and thinking that's a big move. But in percentage terms, they're not different. They're the same. So in this case, the stock is right around 19. If we say there's an 8 out of 10 chance that it can go up, then we can start to look at how far can it go up. So maybe when we look across, we can see it could get up towards that $21 range. That wouldn't be a real challenge. It's been up there before, and it did find resistance, but that's a couple of dollars higher. So that's at least 10% higher. If we look to the downside, there may be a 2 in 10 chance of it dropping now. And if it drops, it goes down maybe as low as $15 or so, down towards that support area that it reached in mid-July. So now we can come up with a risk to reward. And suddenly you've got in your hands an arsenal, a toolkit by which you can measure a risk and reward. And you could say, okay, even if the probability is attractive, maybe the reward to risk isn't as attractive. And that's ultimately where I wanted to get to today, is to get you thinking about probabilities and get you thinking about risk and reward, and think about them as two different things. That typically, if somebody comes along to you and says, look, I've got a stock and there's an 80% chance it's going to move up, you might say, that's great, where do I sign up? But what I really want you to think about when you're trading is not just how much likelihood there is of this stock going up, but what happens if it doesn't? It's always easy to think what happens if it does. That's the easy money. What happens if it doesn't? Well, turns out maybe there's an 80% chance of moving up $2 here. So let's calculate that. So 80% chance of moving up $2. So we've got, let's just say 1.6 on the upside. And then we'll go ahead and we'll calculate what if it moves down. Well, in that case, it's a 20% chance of moving down from 19 to 15. And so that's about 0.8. So what have we just figured out? Well, we just figured out that instead of this being really, really attractive from a probability perspective, maybe it's actually mixed on a risk to reward perspective. And similarly, what you're going to find are times when you have something very, very low probability. You might have something that is a 30% probability of moving to the upside, but it turns out that the risk of a loss is extremely small. So maybe a stock has come down. There's a 70% chance it's going to continue lower, but only by $1. But there's a 30% chance it could move up by 10 or 15 or $20. Well, that's often the stock to get into because it's positive expectancy. And most people who are trading are not thinking this way. It's not a bad thing if you haven't thought about it this way. Most of the banks don't think about it this way. But a lot of the venture capital industry does think this way. If you think about a venture capitalist investing in a startup, they might put some money into a startup and put $1 million into 10 startups, but it turns out Peter Thiel, who puts his $1 million into Facebook, is the guy that makes a lot of money. Because even if the other 9 don't work out, the positive expectancy, the magnitude of the gain when one does work out, overrides all of the losses. Now, a final note on this is that our human tendency is actually to not like this way of trading. So if you're listening to it and you're saying, I hate this, then that's totally normal. And the reason I say that is that there are 2 ways of essentially thinking about trades. One is to look to take small gains repetitively. The other is to take small losses repetitively. You'd argue that clearly the former is better than the latter. But it turns out that neither is actually necessarily good or bad. A lot of it comes down to your own risk tolerance, risk preference. And if you like to take small gains repeatedly, often commensurately what you suffer are big drawdowns. So if you have had big drawdowns and you've also got the mindset of enjoying some small gains repeatedly, that's perfectly fine. Just know that the 2 typically go hand in hand. And I'll talk about that more in a moment. And similarly, if you take small losses regularly, like the venture capitalist investing in 9 startups that maybe 8 of them don't work out, 1 is so-so, and 1 turns into a huge winner, you can end up with a huge victory overall, a very positive expectancy outcome. And it turns out that if you look through some of the investors over history who have done really well, you find that many of those who've done extremely well actually fall into the category of taking hits repeatedly but enjoying very big gains. If you ever read, for example, The Big Short, you would see that. Michael Burry was the guy who did that. Nassim Taleb, who really pioneered the concept in many ways, or certainly brought it to the forefront of the investing public, thinking about those black swan events that come along and really hurt people. So he's not the type of person that enjoys the small gains because he doesn't want the big loss. Conversely, people who actually take those small hits and actually enjoy the big benefits do very well. And you can do so by betting long or short. In 2008, Michael Burry, George Soros, all these people were willing to take losses short term in order to make a huge amount when the market actually crashed to the downside. And the reason I say this is very much a concept that is converse to your own natural tendencies and proclivities is that if there's, in fact, a Nobel Prize given to the creators of prospect theory, where effectively what we know is that people do not like losses sequentially. They do like gains sequentially. You want to test it out. What I mean by that in tangible terms is if you have a partner and they're not listening to you tonight, but you really like them, you can play an experiment on them. And here's the experiment. So find something that they really like. So let me just assume, looking down through the list of names, most of the people here tonight are male. So and all the women out there, you can do this as well with your partners too. But let's just assume that somebody out there, one of the males has a wife, and that wife likes flowers. Now you have a choice. You can go out tomorrow and you can buy a lot of roses. You can buy 12 roses, 24 roses. Give them all to her, and she'll think you're great. That's so awesome. Or what you can do is you can go out over the next 7, 14 days, whatever it might be. Let's say 12 days with 12 roses. Every day you come back, you give her a rose. It turns out that the cumulative effect on the psyche is such that she will actually appreciate the 12 roses over the 12 days more so than she will appreciate getting a big bouquet of 12 roses tomorrow. And similarly, if you were to do something else, which you were to say, you know what, I'm going to, let's say, I'm gonna take $1,000 from you. Let's just say I say that right now. So, Andrew, who's out there listening to me right now, I'm going to take $1,000 from you. Well, Andrew wouldn't like me to take his $1,000. But guess what Andrew would like even less than me taking $1,000? He'd like even less if I took $100 today, 100 tomorrow, 100 the next day, 100 the day after that, because each time I take it, it feels like pain. And it's the same in trading. When you take a loss and then another loss and another loss, it actually hurts more than if you take a big loss all at once. And so it's a concept of segregating gains, integrating losses. Most of us actually prefer to segregate our gains. We like small gains repeatedly, and we like to integrate our losses. We like to take big losses and big drawdowns. The challenge with that is that over time, a lot of the very successful investors in the world don't do that. Now, Buffett isn't the best example of this because he's got some short put positions on global indices, but for the most part, he's quite representative of this, which is that he likes to get into stocks and then hold them for extremely long periods where he's benefiting from massive gains, not suffering the tax consequences on those, and enjoying it for a very long period of time. So there's this massive gain. It's not like he's trying to get in and out and trying to enjoy multiple frequent gains and enjoying that utility. He's actually looking to do so over very long periods whereby the macro, the cumulative gain is much greater. And if there are losses, he can cut them quickly. And I was fortunate enough to meet him a couple of years ago, and it was one of the things he said. One of his worst bets was on some banks that he had invested in at the time. And he put in, I think, about $500 million, and he just wrote it all off. He knew it may come back one day, but he didn't want to deal with taking losses over a period where it was going to ultimately do anything but be written down. He wanted to integrate the losses right away. And then the same thing with the gains. He likes to integrate the gains and ultimately end up over a period of time where the gains are massively outsized relative to the losses. So there are a couple of questions. We've just come up towards the 3/4 of an hour mark, which is where we wanted to pause here. So let me just get to a couple of the questions. Adrian, could you repeat the risk-reward relationship? Yep, the risk-reward is essentially that for expectancy, you've got probability times magnitude, and that's going to lead to expectancy. And when you have reward outpacing risk, you've got positive expectancy typically. When you've got risk outpacing reward, you've got negative expectancy. Mark, your question is, are you talking about people like Jesse Livermore, be right and sit tight? Yeah, exactly, Mark. There's a way of trading which ideally, the Buffett way is you own a company and it just keeps producing cash flows. It's much more difficult for most people to do that, especially if you look at long-term returns. I'm certainly not advocating for buy and hold in the long term, and simply because I think there's when the market has come up as it has, there's a lot of risk. If you've got certain stocks, then absolutely I think you can use that strategy, but you would have to be very, very selective and a very good stock picker. That being said, there's a trade-off between saying I'm going to hold for 20 years and I'm going to hold for 2 or 3 months. Turns out a lot of traders can't even hold for a month because they get really nervous and they want to get in and get out. And if you're a day trader and you're really good at day trading, that's fine. But if you're not, then you really have to question your approach and think about, are you looking to take advantage of small gains frequently at the risk of large losses, or should you be looking to actually let the stock run to the upside, really enjoy it when it starts to take off, and have your exit set so that when it turns around, you're actually going to dynamically adapt to that position. All right, so what I'm going to do is pause the official presentation here, or the more formal part of the presentation. I want to thank all of you that joined here. I'm going to stay on and answer some questions that you may have, if you do have any. I'll let Ron jump in as well in a moment. And for those of you that need to rush off to other things, I just want to thank you all for coming. Hopefully it was somewhat useful. We decided today to go with more of an informal presentation, just a conversation, hopefully a little bit interactive, rather than something more formal, and happy to take all of your questions. So let's get right to them. Actually, how do you calculate expectancy? Essentially, you're looking at probability and magnitude and taking a multiplication of them. All right. Adrian, question is, do you take into account the standard deviation for a measure of risk? Yep, that's definitely the standard approach to it, Adrian. And there's, I think probably what you're talking about is if you're looking at a standard statistics and you're measuring that sigma squared, how do you actually incorporate that into this analysis? And the answer is, for me, that there are a couple of ways to do it. If you want to look at standard betas, you can do that. Risk is often a very difficult term to define, and the reason I say that is because risk is in many ways a function of capital. If you were to look at some of the banking agreements on capital, banks can't even agree what capital is. So if they can't agree on what capital is, it's hard to define what risk is. But I'm digressing a little bit here and saying that if you want sort of a simple way of thinking about it, the way I often do it is the way I presented here, which is to say, take a look at a seasonal effect. For example, the one that we presented there at Cisco, you can say, okay, seasonally, there's an 80% chance it's going to rise over the next 15 weeks. Then take a look at a differential between the current price and the resistance. Take a look at the differential between current price and support. Measure those magnitudes, do a quick calculation, figure out, is a reward or risk way more compelling. Now, it gets a lot more complicated than that, and it can do, but that's a really simple way, and it's a back of the envelope one you can essentially do in your head, and which is what we did tonight, and it's sufficiently good for most people. But I could talk offline maybe in much greater extent about the details of that. Peter, your question. Let's see, Peter, your question, is this Steve system looking for patterns that produce high upside but getting out quickly, below the line, many small losses for the few large gains? I'm always hesitant, Peter, to talk about anybody else's system, but let me comment this way, that essentially the way to really think about trading is to have at trigger. I know Steve likes that 8-day tremendously and with very good reason. And in some respects, it doesn't really matter if it's 8-day or a 9-day. And by that I mean it doesn't really matter what it is as much as that you have it and you adhere to it and you figure out what works. Now, some will work better than others. And obviously the 8-day is a very successful one. So if that's the trigger price, that's what you want to stick to. Ultimately, you want to stay very disciplined. If there's nothing else you do, then do whatever you say you're going to do when you start into a trade, and you'll be much better off. Jennifer, are you saying that many small gains can lead to large losses? Yeah. So Jennifer, let me explain this. It's a great question. Let's give an example of this. Say a stock is at, let's just say $100. And an example of a small gain would be you can come along today and say, if the stock stays above 95, I can sell a put option, I can take in $1, and I can take in $1 this month, next month, the month after. And so you're taking in small gains, and that's good. Or maybe if you're trading a stock, you're just enjoying as it rises maybe above that 8-day and it keeps going, there's a candlestick reversal, and you get out, whatever it might be. You keep doing that repeatedly, and you're taking small gains. I think that's probably a bad example, the last one, because it's not what Steve does. But let's go back to the options example. You're taking small gains. Now, the risk is, what happens if it gets to 85 one day? Well, now it turns out that you may be up 6 months in a row and up $6, but you just lost 10 on that trade. And so there's this commensurate risk and reward that you have to factor in. A lot of small gains often commensurately lead to a lot of risk. It doesn't have to be the case. You can be trading with smaller amounts and looking to get in and out quickly, and there are ways around that. But typically, it's something that you will see a lot of traders suffer quite badly from big drawdowns. Bill, do you buy into Dow theory? Transports must confirm the industrials. I think history would suggest, Bill, that it's something that should definitely be paid attention to. I mean, certainly with FedEx is a company that I pay really close attention to, because economically, when FedEx is suffering, there's a lot of people suffering out there, and a lot of the same principles apply there in terms of the transports. They're very, very key, and it's hard to overstate how critical that is in the world. If you were to look at a big picture level, for example, if you look at money, what is money? Money's worth nothing really without energy. And so if you're looking at a derivative of which is more important, money or energy, it turns out the energy comes first. That's why you'll see a lot of the strategic decisions on global levels are a function of where energy is, because without it, the money really doesn't matter. You could have a country with all the money in the world, but if it's got no energy, that money is not worth a whole lot. And so transport plays into that very keenly, because transport is a function of energy. Darryl, your question, are you matching seasonality with the Mark-Tamer algorithm? They're actually two separate things, Darryl. The Mark-Tamer algorithm looks at, it actually has a proprietary formula which calculates expectancy, which I have not shared tonight, and I've never actually shared. Only a few of us actually know what's inside of that. Seasonality is something else, because seasonality is very important, I think, in identifying at the individual stock level what the likelihood is of something happening. And then separately, you can look at the market timer algorithm as an expectancy approach. So seasonality is something I feel that a lot of people understand at the global level of the market indices, where they look at the adages of sell in May and stay away, the Santa Claus rally, the Halloween effect, the performance from November to May and May to November, but they don't really understand seasonality at an individual stock level, and that's what we provide also. Jim, your question, I think, has been answered by Ron, so let me skip to Jimmy's question. Is your profit chart? Let's see, did you answer Jimmy's question? You have. All right, I think Ron's actually answered most of these questions, so I don't want to be redundant. But it looks like we're closing in on the top of the hour, and I think maybe we've come to the end of this session. If you have any more questions, feel free to type them in last minute. Ron sent me a quick note, so I just want to check to make sure I haven't missed anything. Well, I think that's about it. So, folks,
hey, Garrett.
I want to thank you all for... Yep, go for it, Ron.
Hey, you're doing such a great job, and you're on a roll. I just want to do one quick thing here. I know I sent you the message saying it looks good. But Laura asked a question, and if you don't mind, I'd like to quick do an example of swing lows and stops. All right. So, gang, here we go. I am a monster gold and silver bull as mega. Maybe not as much as maybe Jim Sinclair or some others, but definitely a big bull. And when the miners started to turn in late July and August, now from the seasonal perspective, as we get into the end of August and September, it's a seasonal bullish time for the metals themselves and the miners. October, so-so. I do believe we are living in uncharted territory, so I would certainly not want to be out of the metals markets. But from a short-term trading perspective and momentum perspective, October for the metals is not always the greatest. So you just got to understand that. You don't want to be, in my opinion, the hills going into October. But then when November comes back, it's back to the bulls again into early December. Now, what Laurel's question was centered around trailing stops, and I like to add in swings and so forth. When we started to break up here using GDX, George Delta X-Ray, the gold miner ETF, we came up, we came down, and we finally had from here to here being a swing low. I'm going to zoom in a little bit further, not a whole lot. There we go. So, Laurel, what we can do is we can use these swing lows as points to say, all right, if the bulls are coming back into the miners, I mean, if we took our hand and covered the screen, you wouldn't see anything past August yet. And you'd say, all right, well, got a higher swing low. We look up a little higher, middle of August, we quickly go up. So what's happening here is we're getting these little mini swing lows. So whether this stock is Walmart, Amgen, or GDX, we can keep moving our stops with these swing lows. Now, one of the things I know Steve likes is the 8-day EMA. We like that too. We also use a 5-day EMA. We can use those moving averages as lines in the sand, but you can also incorporate the 8-day with a swing low too. I mean, there's different ways to do it. Just find one that you like. I like swing lows. I also like to pay attention to candlesticks. So we're moving up. We get these higher swing lows. So each and every time you can move your stop up to that swing low. Now, the way I like swing lows is on a closing basis. I do not like trading intraday basis for swing lows because sometimes you get those dips down where they're running the stops. And it happens a lot in the metals markets. We start moving up again. We come down. And we talked to our members and we said, you know what? We have 4 days in a row, 5 out of 6 of down movement right in here. Okay, let me zoom in again. But if you look at the volume, it was very pathetic, very, 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 very light. It was almost a controlled descent, a profit taking. And then what happens? Kaboom. So another example, Laura, would be if your stop was here. Remember, we're just going to swing points. That's where buyers overtook sellers. Nothing really fancy about it. They came back with a vengeance here. New swing low. That should not be violated. If it's violated, then short-term trades can be exited. You start moving up again. Now, this isn't much of a swing low. It's more of a consolidation. But then we had the explosion due to commentary in the U.S. and Europe about the good old printing of the money to infinity and beyond. We think Uncle Ben is doing his best Buzz Lightyear impression, huh? To infinity and beyond. We had this big pop, and now we're starting to have a little trouble. We're sort of consolidating. So what we can do is we could move our stop up to the next pause point. Not the greatest swing low in the world, but it can sort of do. What you don't want to do, in my opinion, is leave your stops way down here. That's not what short-term trading is about. Just keep sliding them up like a ladder. Well, guess what? We had a nice little metal shakedown on the 26th. 2 days of heavy selling in terms of bars. The volume was high, but not excruciating. And then what happened? Reversed. We got back above the 5 and the 8 day. So based on that, this is now a swing low. So if the bulls are going to stick around, and maybe October won't be too bearish, and I'm not expecting a massive bearish move, but we don't know, it could happen. October just isn't the greatest month in the world for the metals market. If we move below there or close below there, we can simply exit GDX for short-term trades. That's one way of doing it. You can use the 8 day. In fact, this Sunday, we were talking to our members and saying, listen, there's 2 ways we can do this. And probably the most popular way is this one. Let's just say you had 100 shares of GDX, or if you had 1,000 shares of GDX. Divide it in 2, meaning if you're short-term trading these metals and we close below the 5 day or the 8 day, I know Steve likes the 8 day, half the short-term trade can be gone. The other half is gone if we take out the swing low. Now, you don't have to be that risk tolerant. You could just say, you know what, if it's below the 8 day, we're out. We're not going to ask any questions. But given the metal's rise in relationship to the dollar already, I think that, we talked in the beginning of the year about this being the year of the miner. They're finally starting to perform. It's my expectation that we see the miners go way beyond, well, I'll say what I think, way beyond double of where they are now. And that includes GDXJ. I think GDXJ could be something silly like a triple or quadruple. Maybe even a 5-bagger till this is all said and done over the next year or 2 years, maybe 3. We'll see. Not that long, though. So what I like to do is when I'm trading the metals, for instance, and moving the stops up is have sort of 2 piles of money or 2 piles of trades. If you believe that gold and silver are going to move higher, one pile that you say, you know what, I'm not going to touch, period. The metals markets are constantly manipulated. There's constant interference. And if gold and silver drop 50% tomorrow, you wouldn't touch it because you're in it for the long haul, because they are in secular bull markets. Huge difference than what equities are in. Secular bull markets last years and years and years, decades. So pullbacks are gifts with silver and gold. Being buying at the wrong time is made up for with more time. It corrects your mistakes, which is not true if you're dealing in standard equities right now, even despite QE. So if you're looking at GDX, just slide it up. Same thing. You just keep moving it up. So the low on the 26th, which was Wednesday on GDX, that could be the final stop for short-term trades. Now, if you put away 100 shares of GDXJ that you don't want to look at for 2 years, this means nothing to you. But short-term trading, what we don't want to do is give back all these gains. That's what's going to be very, very important. Similar, if we look at SLV, there's Wednesday's low. We should not go below Wednesday's low if the bulls are truly back. Otherwise, it could lead to a bigger correction, and we don't want to get caught in that. Now, the 8 day can be used, but I do like Wednesday's low for now. So again, same thing. Let's say you have 100 shares of SLV. You can bail on half on a close below the 8-day, and the other half, short-term trade, is bailed on below Wednesday's low. So that's a nice little way of doing it. And you can apply this to individual miners like Silver Wheaton. Now, Silver Wheaton is a much bigger mover. So you start saying you're going to wait for a close below Wednesday's low. Well, holy guacamole, that could quickly turn into a 15% loss from where today is. Because when Silver Wheaton has a bad day, it can lose $4. And all of a sudden you're way down here. But when you're using these trailing stops, you just want to have a plan. And whatever that plan is great. It's planned out ahead of time. So when it happens, you just get out of the trade. You're mechanical. You're not emotional. So, Laurel, I hope that helps. I just wanted to throw that out there. I don't want to. You get me talking about the metals, I'll talk forever. So we can wrap it up there. Gareth, I'll throw it back to you for any last messages. But I do want to say thanks, everybody, for coming. We appreciate your time. Hopefully you enjoyed more of a free-flow format. And we look forward to seeing you guys again real soon. So, Gareth, you're all yours.
Thanks so much, Ron, and thank you, folks, for staying with us, joining us this evening. Peter, Jimmy, SG, Laurel, Albert, and everybody else who is here, we really appreciate your time tonight. Have a wonderful evening. We look forward to speaking with you soon. All the best. Take good care, folks.